Good afternoon, and welcome to the Energy Perspectives Group webinar hosted by Riley Exploration Permian. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Thank you, Sabrina, and thank you to everyone that's attending today. We're going to take an in-depth look at Riley Exploration Permian. It is one of my top picks in our small cap growth portfolio. And if you think of any questions during the presentation, just type them into the chat box and we'll cover them during the Q&A part of today's webinar when Philip's done with his presentation. Now, if you are a non-EPG member and you want to find out more about Energy Perspectives Group, send an email to Sabrina at energyperspectives@gmail.com, and we'll send you a link that tells you, what we do for our members, and you can decide if you'd like to join. We are a networking group for energy sectors investors, and we have a global membership, and it's been growing by 10, 15 members a month here this year, because since the energy sector is the only thing that's making money. Anyway, today's speaker is Philip Riley, the company's CFO and Executive Vice President of Strategy. Also on the call is Bobby Riley, Chairman and CEO. And I think we got Kevin Riley also on the call. Philip was appointed to Riley Permian's CFO position on September 1, 2021, almost exactly a year ago. Previously, he served as the company's Executive Vice President Strategy beginning in March of 2021. So he has more than 20 years of experience across energy and other industries as an executive officer, investor, and strategic advisor. Prior to joining the company, he served as managing director of private capital funds Bluescape Energy Partners beginning in May of 2015 and Parallel Resources Partners beginning in November of 2012, where he formulated investment strategies, sourced investment opportunities, and managed existing investment operations and performance. He earned a bachelor's degree from the University of Texas in Austin, a Longhorn. He majored in business honors program and finance. So at this point, Philip, I will turn it over to you and I will go on mute, and then I'll come back to join you after your presentation. So take it away.
Thank you very much, Dan. Appreciate the opportunity to present today. Hello to everybody. Thank you for your time. Look forward to presenting here and then answering some questions with my colleagues here in just a bit. I'll be flipping through our current presentation. It's available on our website as well as many other items. Typical forward-looking statements, full cautionary statements in our SEC filings and such. All right, Riley Permian. We are a roughly $500 million market cap exploration and production company with domestic assets and domestic operations. Most of our activities are focused in the Permian Basin in a single contiguous area. Sale of oil represents over 90% of our revenue, with the balance composed of gas and natural gas liquids. A key characteristic of our assets is the low base decline, meaning the wells decline slower than the high decline shale wells, making up the majority of U.S. production today. So our production volume growth is more easily achieved through organic drilling and lower CapEx spending. Another key characteristic is that our ongoing production has low operating costs and high profitability, really low break-even WTI price for production, maybe $20 a barrel WTI, which is burdened by the OpEx, G&A, and interest. So these characteristics combine to enable us to grow production in boom times, as well as the economic lows, such as the pandemic years just a couple years ago. These characteristics have also resulted in enough free cash flow after CapEx spending for production volume growth of roughly 20% a year and to fund a growing dividend payment to shareholders. Again, during both boom times as well as the economic lows. Oil and gas is a very large global market, and relative to some of the world's participants in this market, we believe we're a responsible producer, developing and selling what we call better barrels, attuned to environmental, social, governance principles for solid corporate stewardship. Thinking about our strategy, it's simple and can be summarized in probably 3 points. First and foremost, we're a growth company with a track record of organic growth in the 20% per year range, with a forecast of continued organic growth. We may choose to slow that somewhat, but still aim for double-digit growth on a volume basis. Second, we're always pursuing new investment opportunities, which could include both traditional oil and gas activities and new ventures. An oil and gas focused example is our EOR pilot project, which has objectives to lower our base decline even further, and in turn lead to long-term sustainable corporate cash flows. And a new venture example is the work we're doing in carbon capture, pursuing partnerships to capture industrial sourced CO2 emissions and store them on our property, taking advantage of federal tax credits, realizing synergies with our core business, and ultimately diversifying our business with another revenue stream. And finally, we're creating value and returning that value directly to shareholders. We're generating value through the drill bit, converting undeveloped reserves to developed at very attractive rates of return, and we're paying dividends. We've paid dividends for over half of our corporate life, with a current dividend yield of around 5%. Track record. We've built a company and production base from zero production in 2016 to over 10,000 barrels equivalent per day as of June 2022. This includes year-over-year compounded production growth of about 36% going back to 2018, or over 22% per year over the past 3 years, which includes 2020, the pandemic year, when we still had growth but much lower development activity. When you look at EBITDA, the growth is even higher, over 40% per year for the past few years. And equally, dividends grew at 34% per year through June of this year. Now, some of that growth is admittedly due to starting off a smaller base, but we do forecast growing production by over 20% this year, and we hope to grow the dividend by high single digits to 10% per year in the coming year. This page is a little busy, but gives you an overview of our asset, both on a geographic basis and geologic setting of our core asset. We're operating on a geologic structure called the Northwest Shelf of the Permian Basin. Hydrocarbons settled here in this basin. They settle in basins, but they also have a natural migratory effect up to the Earth's surface, being lighter than water. We're very fortunate to have this asset, being in a really premier neighborhood, sharing a fence line with 2 fields, kind of above and below, you see here on this map, that produced over 2 billion barrels of oil. These were first developed more than 100 years ago, and by today, these fields have thousands of vertical wells, many of which are more marginal, as well as secondary recovery efforts, water and CO2 flooding. By comparison, we're developing our field with modern techniques, including horizontal drilling and hydraulic fracturing. We're getting contact with more rock and more reservoir doing this, fewer well bores, resulting in more efficient CapEx dollars spent. So our wells are much more prolific, some of which have initial peak rates of nearly 1,000 barrels of oil per day. Page 7 here gives an overview of our proved reserves. This represents internal estimates by our reservoir engineering team, and which represents interim updates to the once per year reserve estimates we receive from our third-party engineer, Netherlands Sewell. We estimate we have approximately 78 million barrels equivalent of proved reserves, 64% of which are oil, 59% of which are proved developed producing, so already online. From a value perspective, using June 30th prices, present value at a 10% discount rate for the total proved was 1.1 billion, or just over 800 million for the producing portion. Both of those figures might be compared to our public market enterprise value of about 550 million. And then the metrics at the bottom provide some highlights, including our average finding and development cost, just $6. That's, I'd argue, among the very lowest in the industry. Reserve life of 13 years on a producing basis, 22 years on a total proved basis, and then also the growth we've achieved over the last few years. Page 8 here, start to discuss the potential upside through EUR and CCUS initiatives. Provides an overview here, on exciting kind of future potential we see with these two. EUR stands for enhanced oil recovery, using CO2 injected in the reservoir to improve the flow of oil. You can see here on this map the infrastructure developed decades ago here in the farthest west part of Texas. The infrastructure was built decades to support EOR fields in the Permian Basin, including one of the largest projects in the world across the fence line from us. It's operated by Oxy and Exxon. That's what I showed on the few pages before. You can see that really concentrated area. We're really just right in the nexus of that. It really gives us a strategic advantage. It allows for quicker tie-ins, lower cost tie-ins. We're early on some authored studies, and we've done some modeling on our assets, service providers, and believe that our asset possesses sufficiently similar rock properties to justify an EOR pilot project that we've already begun. And then next, kind of what we focus here on the right half is the CCUS angle. So this same CO2 pipeline network, it could be used for carbon capture activities, collecting industrial source CO2 and transporting it to our property. We see ourselves fitting into that as being a key storage counterparty. We can be the sink. The IRA bill signed into law this past month that materially increases the federal tax credits available by about 70%. So that represents a potential new revenue stream for pure permanent storage carbon capture, and then real synergy with EOR. Now, when looking at EOR by itself, this page just gives a few highlights of the strategic rationale. That includes flattening the production decline curve, increasing ultimate recovery, pulling forward the NPV, and then simply looking after the planet when combined with carbon capture. A few thoughts on ESG. Oil and gas continues to be the #1 primary energy source globally by a long shot. With oil alone, Riley Permian is just a small participant in a $3.5 trillion per year global market. And we've witnessed a structural downward shift in investment in oil and gas over the past few years, partly in response to shareholder priorities, mostly for domestic companies to give more capital back, but more broadly in response to growing ESG mandates and shifting of capital allocation globally. We are believers in the many positive aspects that ESG can bring to corporate governance and stewardship. And this page highlights several of those ESG metrics for which we're proud. We balance our objectives producing low-cost energy with our commitment to looking after the environment, our employees, and our shareholders. But we're also seeing a refreshed welcome dialogue this year, particularly re-examining ESG based on perspective and context. In the last 3 years, we've experienced foreign supply chain breakdowns, leading to rethinking of offshoring manufacturing and labor, as well as dramatically heightened geopolitical tensions, global energy crises across continents. And so in this context, we believe that providing basic energy needs from a responsible source should be valued. And so at Riley Permian, we're a U.S. company with 100% domestic operations, 100% domestic staff, responsibly producing 100% domestic natural resources that are among the highest demanded products in the world, which help clothe, feed, shelter, warm, cool, and transport our global population. Finally, here are some investment highlights. We've got a track record of growth and value creation through business cycles, high and low. We've got a premier asset, an aligned team, top quartile performance and profitability metrics, exciting upside through EUR and carbon capture ventures, and we're consistently growing dividend payments that we plan to continue growing. We've got an additional section here of recent performance and new guidance. I'm not going to go through that, but I'll just offer a short summary. In the recently completed quarter for which we reported results, we generated record oil production, revenue, and operating cash flow. We increased in our most recent earnings call midpoint guidance for oil production for the fiscal fourth quarter by about 6%, and for the whole year by about 4%. We're forecasting growing by 22 to 24% year over year at this point, all organic. Free cash flow should be improving, even with lower prices, on account of legacy lower priced oil hedges rolling off, as well as some improved gas processing rates and higher gas prices. Related, we see opportunity to pay down our debt in the coming quarters, further strengthening our balance sheet, for which we already have really low leverage, about 0.3 times. And generally, we forecast building liquidity just to pursue various growth or shareholder return initiatives. I think with that, I'd turn it back to Dan and Sabrina, and we can take your questions.
Sorry, I was just waiting for Dan to get back online. Give me one moment.
You hear me now?
Yes, there you are.
Okay, I'm sorry. I don't know why I clicked on mute. Okay, I've got some questions that were emailed to me, so let's do those first, and I'll get to the ones that are in the chat box, and actually they're kind of the same question. So I know that you had a third-party gas processing facility that was offline for a while that impacted your second quarter results. Is that plant back online, and what does that mean? Are you going to be able to get more NGLs and stuff going forward? Can you hear me?
Dan, hi, this is Kevin Riley. I'll answer for that. Yes, as of the end of June, 1st of July, the plant expansion has been fully commissioned, and we are producing above our new MDQ, which increased from 10 million a day to 17 million a day, and we have done so for about a month and a half now.
Okay. I don't know. I think we were seeing Philip's other screen or something there for a while. So Kevin, you may be it now. Okay. So that's going to help you going forward, right? You get more gas.
That is going to help.
Okay. A question here. This was emailed me, and I kind of had the same question. Tell us, why do you pay a dividend? When you went public, did you roll up a previous drilling partnership or something, and they were expecting cash flow? Because most companies your size are more focused on growing production, improving reserves at this point. Kevin, I think you're muted now.
Okay.
Okay.
I was assuming Philip would chime back in, but as a private company, we did see the ability to be conservative in the way we approach our development plan and our capital investment. Being that we have this asset that has a very low decline rate, we thought it prudent to go ahead and start paying a dividend as a percentage of our total cash flow back starting, I believe, is in 2019, and have now paid over the last 14 quarters approximately $68 million.
Okay. Are you still?
Yeah, it was really, just to add to that, Dan, from the beginning, we were built with our private equity sponsors just to be able to grow and grow at an existing cash flow. And we thought it was, as Kevin said, good discipline to pay a dividend from the beginning. It's a way to both, it's good balance to have both increasing net asset value, but also give that real tangible return of capital. And so that's what we've always done. And it turns out we were a bit ahead of the trend, and other companies, we're thankful our industry is doing it to show some good discipline. But it's just something that's always been kind of part of our DNA.
Okay. Okay. And you're able to fund those dividends completely with free cash flow?
That's right.
Okay. So another question, are you seeing cost inflation in the field, and are you experiencing any supply chain problems?
I think that is a common thing across the industry and across multiple industries. Yes, supply chain is an issue. It's real, both materials and people. We've seen costs increase about 30% year over year. Fortunately, we have been focused on planning out ahead, so we've been able to secure most of the materials and services for the foreseeable future. But costs and supply issues do intervene with activities, and being able to flex up and develop a lot faster, or even slowing down because it impacts commitments you've made.
Okay. Are you guys still on track to complete 7 gross, 4.2 net horizontal wells to sales this quarter?
Yes.
Okay, good. And are they just being completed evenly throughout the quarter?
We have one more well that is being completed as we speak for operated. And then I think we have one or a 0.1 or 0.2 net wells that's non-op that's currently being completed. But the other wells, the completion process has been completed.
Okay. Okay. And so you don't have any problem getting them completed and easy tie-ins and stuff?
Oh, that's all. Yeah, tie-ins are very easy. Fortunately, the completion dates were secured well in the future, so we have just been completing as planned throughout the quarter.
Okay, so you have gas gathering
Yes,
facilities.
most
and
of
stuff.
our field has takeaway capacity for oil and gas through pipelines, along with water and our own water infrastructure.
Okay, good. Let's see. Talk about your hedging program. We'll get to a minute. The one question I had, I was looking at your PB10 net asset value. Now Kevin's Philip's taken down his presentation, I think, because I can't see it now, but I know you have a like a 6/30/22 reserve report. Is any of that based on the success of the CO2 flood?
Zero.
Okay, so that you got a lot of upside. If the CO2 flood works, you're going to get a lot more proven reserves.
Yes.
Yeah. I went to work for Hess in 1983, and they were just starting the Seminole San Andreas unit, and it was turned into the biggest oil field in the entire company. Got up to 64,000 barrels a day. But okay, when are you starting to inject CO2 already?
In the fall.
Okay. But you've got it all sourced and everything. You just got to get all the stuff laid in.
We've got the infrastructure built. We've got the contract to buy the CO2 done. We've got a physical type to the pipe running through our property. We're waiting on some compressors to arrive here.
Okay.
But we've been injecting water, and we'll be starting here in a couple
What
months.
was the area of was it already a water flood?
No.
Oh, okay.
This has only ever been developed, primary.
Oh, just primary. Okay. So then you're going to get, because when we did Seminole, that had been a water flood for a long time before they started the CO2 injection. How soon? So how many wells, or how big is the pilot program area?
It's one portion of a 960 acre unit. We've got a couple patterns of or 2 rows of injectors basically in between 3 horizontals, if that makes sense. So it's kind of
okay. You got one producer in the middle and one each on the outside, and then the injectors are between them, right?
That's right.
Okay. And how soon, once you start injecting, I mean, what would you expect to see your first increase in pressures and increase in production?
Oh, we're hoping for something within maybe half a year.
Yeah, when we did it at Hess, I think it took like 4 to 6 months. But I will tell you, once it started going up, it just kept going up. Of course, it was a much larger project. So anyway, okay, let's see. So how much more development well drilling do you have to do in that area?
Kevin, you want to speak to that?
How much more development do we have to do in the CO2 pilot area? Or
No, I'm talking
across?
about the overall field. Do you have a lot more horizontal drilling locations?
Yeah, based upon our, historical run rate, we believe that we probably had 8 to 10 years of development.
Oh, okay. So drilling what? How many per year? Like 15, 20 or something?
In that range, yes.
Okay. All right. I think cost inflation, tell us about dividend, blah, blah, blah. Third-party processing plant. Okay, I'll get to these. Okay, let's talk about your hedging program. We all wish we had perfect vision of the future and wish we hadn't hedged, I guess. But let's talk about where you are in your hedging program, and then where you are where you're headed in 2023, and then kind of what your hedging strategy is going to be going forward.
Yeah, so we came into both 2021 and 22 with a large amount of hedges, legacy from kind of 2020, much lower prices. I think in general, we're trying to find a common middle ground of not being too hedged, so we can be flexible with current market environments. Your top line can react like your cost line is. We've got plenty of cost increases in service and inventory, and so we want to be able to react to that. We've also, at least until the last maybe month, had very steep backwardation. So you combine those two concepts, we really didn't need any more hedges, in our opinion, for 22. We're over half hedged. Want to have some market exposure, whether that's over $100 or $95. If anything, we'd be adding a little bit more to 2023. And if you look at the strip, it really hasn't changed too much there. The backwardation has flattened quite a bit. We've lost quite a bit, but the prices have not declined too much there. So I would expect to see us put on maybe a little bit more as you roll through that. You see in some of our profile, we have in an appendix a graph. We get down to the 30% and then kind of mid-20s. We may choose to increase that a bit to protect some of the drilling program if we're then committed to it. But we still do want to just have the market exposure. We're not trying to time the market necessarily. We're trying to run a company and be efficient about that. We'll use a combination of probably some collars going forward to give us a little bit more flexibility. You don't have all the noise running through the income statement as much. And all of this is predicated on a low leverage model that we've got right now. To the degree we used more debt for a special purpose, then we'd probably be getting some corresponding hedges.
Yeah. Are the hedges required by your debt covenants?
They are, and that's something that's changed over the last. They've always been required, but the requirement has changed over the last year for two reasons. One, we restructured our debt agreement, amended it to where the covenant is looser, and it's a test based on our utilization, and that utilization has gone down. We've been paying down debt, so that we've got more leeway there. So it's less of a contractual commitment and more of a strategic decision then for management and the board.
Right. Yeah, I would suggest as much as you can use cost us some collars or just buy puts. I see this as a global energy crisis, and I think oil and gas prices, the potential for them to spike a lot higher, I think is really there. I would think we would need a very serious long-term recession to bring down demand from where it is now. But anyway,
yeah, I mean, that's what, look, we see some volatility, as for instance, Saudi Arabia said They see the structural underinvestment as well. No doubt we're probably going to have some short-term volatility with certain recessions, what's happening in Europe and such. But people are still using oil, right? I mean, they're doing gas to oil switching over in Europe just for power. So it's not an easy answer that a recession necessarily corresponds with significantly lower prices.
Yeah, look at the price of coal.
Yeah.
Then you'll see where all this wind and solar stuff is going. I think at the next Paris Climate Accord meeting, there's going to be a few protesters outside that. I wonder how many people will even attend it. Anyway, interesting. A question here about your dividend. It said, guy named Richard here, in early investor presentation, dividend was to be based on 10 to 25% EBITDA. This is no longer appears to be the case. I understand wanting consistent growth in dividend, but guidance in the conference call of high single-digit growth coupled with a stagnant share price is disappointing. Why the switch from 20 to 25% EBITDA to a much lower percentage?
Yeah, well, first we're mixing a couple percentage things in there. So originally that 20 to 25, that was from an early presentation. Early presentation corresponded with much lower oil prices and hence much lower EBITDA. So we had a higher percentage of a lower number. You roll forward, we have dramatically higher prices, dramatically higher EBITDA. We have increased our dividend and plan to some more. I'd point to look at what our free cash flow has been and likely will be. We're distributing, say, 75% of it in the form of dividends. So it's a high payback ratio. It's not that we've been sitting on a bunch of the cash, right?
Right.
The other thing, when we reference then, I think the question says the 20 to 25% range and then down to 10. 10 means 10% growth, not 10% allocation. So we've already been allocating 75% of free cash flow, which I think we're talking about it in cash flow terms, which is more or less the same as EBITDA. It's going to not be far from what we talked about before, granted on higher cash flow numbers. But we last raised the dividend in the October, kind of November timeframe a year ago. Our plan is to generally pay for at the same level and then raise it. So, we don't have any formal approval from the board, but you can draw a conclusion as to when we'd raise it next. Yeah.
And I would just tell everybody, I think looking to pay out a high percent of EBITDA is one thing. You got to look at free cash flow. I don't want to own a company that is dipping into debt to pay me dividends. And
exactly.
Yeah, you should only be paying out like 50.
Differently. That's why I was referencing free cash flow, because if you think about, there's three uses of operating cash flow at least, and that's reinvestment of cash flow,
right?
For CapEx. The other is dividends. The other is just pay down debt and build up cash. Well, we haven't paid down much debt. We don't have much, but we haven't paid down much. We've really just been either reinvesting it or to grow, which we think is creating value, or we've been distributing it. Going forward, you're going to see that mix. Maybe it's lower reinvestment rate because again, the cash flow is improving. You got the hedge roll off combined with some growth. And we don't need to reinvest as high as a percentage because of that. But the dividend on an absolute basis will be growing. And then the last thing I'd say is, look, we want to do something where it's sustainable and have this nice, pretty graph 5 years from now where it's always steadily increasing on the dividend, but not get ourselves in a situation where you have to take 2 steps back if, say, prices fall back to $50 or something.
Yeah, you don't, once you start paying dividends, you never want to cut the dividend. That's just a killer with your investors, because the people that invest for dividends, as soon as there's any decline in the quarterly dividend, they dump the shares, and it's just a killer. So anyway, and if let's say the EOR project just works as good or better than you thought, and oil prices are high, you're going to want to expand that EOR project fast. I mean, that's where that's where you're going to really start adding some serious proven reserves. I'm telling you, at Hess, that EOR project, it was every year for about 10 years. The production kept going up, but so did the proven reserves for like 10 years. It was phenomenal. So there's upside like crazy. Right. So right now, what percentage of your oil is hedged? I think I got it on my spreadsheet.
In the coming quarter, we're kind of at the 50% range.
But then it drops way off next year, right?
Yeah, that does. The illustration, the graph is there in the presentation, assumes a kind of 15% year-over-year growth. So we think that's directionally correct, and that does start to drop off.
Yeah, I will tell the EPG members that are on the call here, I have built into my forecast model a table at the bottom that shows all their hedges, and then I try to see how it's going to impact their realized price, including cash settlements, in a table to below and to the right of the actual forecast. So if you download the Excel, you can see it, and then you can play with the price. You can put, if you think oil's going to go to 80, put 80 in there, and all the numbers update automatically. So it's a real nice tool if you figure out how to do it. Let's see, what's the timeline on the CO2 injection? You're gonna start injecting CO2 here in a few months, right? October or something.
I'm sorry, could you repeat the question?
Okay, what is the timeline of the CO2 injection of the EOR project?
It forecasting to begin in, call it November.
Okay.
With compressors arriving and installed.
Yeah. Okay, next one. We are starting to see some companies in the public market push more for production growth rather than waiting for the equity markets to reward high payout and capital discipline. Any thoughts here regarding Riley's strategy?
Yeah, that's been our strategy. We've been pushing and a leader in that respect. The large caps have felt constrained based on shareholder pressure not to grow. We respect the position, but we've reinvested higher amounts to grow. That's that 22 to 24% year-over-year volume growth. It's all organic. So we've done it so far. We see value to continue to do it. We may choose to grow a little more cautiously this coming year, just given some of the volatility, potential recession we're seeing, but we're still making great returns at new wells, even if oil's $80 or $70 and not just 120.
Yeah, that's the one thing when the oil prices go up and they pull back a little bit, people don't understand the actual lifting costs, production taxes, lifting costs, operating expenses are, $15 or something. I mean, you're still cash flowing very strong at these prices. And I would personally like to see higher production growth, because what are these horizontal wells, your typical horizontal well, are their cost?
Depending on lateral length, but I would say somewhere between 4 to 5.2 million.
And they're paying out, how fast they pay out at $90 oil? I
think the last time we've seen that it's 8 or 9 months.
Yeah, I mean, you got wells paying out in less than a year. Let's go drill a bunch of them. Anyway, you can get the pipe, right? Did you expect that? Okay, a lot of questions about, you got a lot of dividend holders, right? Did you say you expect the dividend to grow mid or high double digits?
No, we said
no. Okay.
Yeah. Call it 7 to 10%. I mean, we're talking 31 cents existing, so it's not a large number of cents.
Yeah. And well, I've got in mind, maybe they're thinking about production growth, because in my forecast model, I've got you at about 19 to 20% production growth this year and then 21% next year, on a, keeping the capex around the same kind of dealing program. So is that maybe what they're getting mixed up with here?
Yeah, possibly. It wouldn't necessarily be the same commensurate growth with, you had some $120 type price this year. So it would represent some potentially lower cash flow. We see cash flow growing next year based on the roll off of the hedges.
Yeah.
But it kind of goes back to we want to make sure the dividend's sustainable. And look, we manage the company day to day and quarter by quarter. if we're sitting in a really great position and board wants to raise it further, then that's certainly a possibility.
Yeah. Here's something, just a question that popped into my head here is, yeah, your NGL price was $34.71 in the last quarter. Where are you now? What are you seeing for NGLs out there?
Yeah, this is a function of some deducts, the processing fees, but somewhere in the kind of, I think 25 to 30% of WTI is usually directionally correct.
Okay. All right. Here's a question. Do you have ample supplies of water out there, I guess, for drilling our water flood?
Yes, we have. We produce and handle and dispose of our own produced water out in the field, which is about 65 to 70,000 barrels a day currently. But we also have additional access to fresh water for completions and such.
Yeah. Hey, on that carbon capture credit in the new law, in a nutshell, can you give us, how does that work?
Yeah, so there's two components, primarily two types. One is for EOR and one's for permanent storage. It's a higher fee for permanent storage. That requires a certain type of well. It's a Class 6 permitted well, typically approved by the EPA. That by itself, you're not creating values, at least in our current construct. We don't have a carbon tax, right?
Right.
So that is reliant upon a government subsidy. You buy the equipment, you put it in the ground, you capture it, you transport it, you put it in the ground. And you've also got other constituents to make sure you're in accord with. That includes potentially the mineral owner, the surface owner, and the insurance and so forth. That's a higher credit, like I said, that increased pretty significantly. And then at the same time, you've got EOR, and that allows you to take the CO2, use it for an EOR project. And so instead of using natural CO2, you're using the industrial CO2. And part of the goal there is effectively just to reduce that cost dramatically, maybe to get it for free. So yeah, on the dollars, I'll quote these in tons. The EOR credit went from $35 a ton to about 60 is the new credit. So 70% increase there. And then permanent went from $50 a ton starting to $85. So it gives you a difference there, the $25 premium for the permanent storage.
But now permanent storage, you're talking about just injecting it into a dead zone?
That's right. That's right.
Oh, okay. Well, I mean, I don't know why they would care.
Yeah, in addition to the, what they're trying to do is, incent, I guess, that permanent versus helping out an oil company, which they see as
yeah, helping make us more energy independent is a bad thing.
Yeah, right.
That's the way people in Washington think, you know.
So there's other improvements, like it reduces the minimum threshold size of a plant pretty significantly. You've got some 5 years of direct pay potentially versus it having to be a tax credit where you had to be an income tax payer. That's potentially material. Granted, we also may be a taxpayer at some of these higher oil prices.
Yeah. So yes, so you can. That's a refundable credit you can get.
That's right.
Yeah, well, that's good.
It's like
that's
them
good.
writing a check.
Yeah, they send you money for a change, right? Okay, moving on here. Who are your largest shareholders, and how are they positioned as to keep holding their position? Is Riley able to buy back blocks from those holders if necessary?
Yeah, so I can speak to that. So I'd say we have four large holders. Companies formed privately with these four, and then did a reverse merger, and then also did one kind of modest-sized equity raise last summer. But prior to that, it was just four. Largest shareholder is Yorktown Energy Partners. That's a private equity firm out of New York. Been around about 40 years. Very impressive track record. has started companies such as Concho that was ultimately sold to Conoco.
Yep.
They own about 30%. Second largest is Bluescape Energy Partners. It's a private equity firm out of Dallas. They own about 26%. That's where I personally spent a decade. I helped put the deal together for them, and then that's how I got involved with this group, just serving as the investor and director for 5 years before joining as an officer. Stepping down, then you've got two Canada family offices. They're based in Calgary, and they own 10% each. One is the Vandenbrink family, and one is the Libben family. So all told, they're just kind of in the 76 to 80% range for those. What I can say is those groups, they all like the story. They like holding it. The private equity groups are held within private equity format funds, which have a finite fund life. Typically, those are kind of 10 years to sometimes they can be longer, call it 15 years. They do have to make distributions from time to time for older ones. We saw that last March with Yorktown. They distributed a few 100,000 shares to their limited partners. It doesn't have any indication of whether they like the story or not. They just, it's part of their obligation. So you'll see that some and continued in the future. We know that'll happen, and so it's just our job to kind of manage that over time to prevent disruptions. The good thing is we have open dialogue with all of them. Yorktown's on our board, and it's something that, like I said, we'll manage going forward.
Okay,
the question I think I saw, do you have the ability to buy some of those back? Yes, in theory we do. As we continue to get further along, if we continue to have plenty of excess free cash flow, we have limited debt, we could certainly make a case to do some buybacks. Now, it's a little bit counterproductive to us increasing the float, but there's ways that you could work that, and maybe you could have special ability for the company to step in and buy some here and there.
Yeah, or they could sell to another fund without just dumping it onto the public, right?
That's right.
Yeah, so they don't have to run it through the market. So, question here from Jim: how many acres do you have leased, and what is your lease rate? Is a lot of your acreage is held by production, isn't it?
Yeah, most of our acreage is held by production, and we have approximately 29 to 30,000 net acres across our positions. Lease bonuses vary depending upon where they're at, but we're not doing a whole lot of active leasing. Maybe occasionally we'll pick up a few acres here and there just to clean up a drilling unit.
Yeah, and do you have other operating partners, don't you?
We do have some non-op partners in some of our wells, but nothing material. On our operated wells, we average approximately 94% working interest. And we have about 3 to 4% of our total net production is from non-op wells that we participate in.
Oh, yeah.
But we don't have a whole lot of non-op activity.
Okay. On an acquisition front, are you seeing any deals adjacent near the existing portfolio that makes sense at these prices that could give you tangible scale to drive efficiencies, or even packages in or out of the basin priced low enough to be accretive on a multiple of our free cash flow basis?
I could go first. We see things from time to time, nothing in the immediate adjacent area. We have looked at some things just regionally in the Permian. Our philosophy is generally if we like things and our strong technical team likes it, for the subsurface properties, we can certainly put a bid in on something, and we'll bid at a level that we're happy with that would be accretive. And thus far, we haven't been the winner on things, which you could interpret as the rest of the market being willing to pay more, or maybe it being a better fit with them. But we continue to look at things, and we're certainly open to those type of deals that could offer a new strategic rationale or some diversity or some scale.
Yeah, and if you found something you liked, would you have a preference of using equity versus debt, I guess, or cash? Obviously, both have their pros and cons depending on where you think commodity prices are going.
Yeah, that's fair, or where you think your stock price is valued and such. That's exactly right, Dan. It's pros and cons. Leverage, we're going to want to be prudent with it. We've got a lot of capacity, but, generally want to keep leverage in line. The stock, in theory, can represent some currency to use, but again, want to take care of our shareholders. We don't want to do something dilutive there.
Yeah, and especially if you think, if you think your stock is undervalued, you don't want to use it as currency, I guess. But if you got the liquidity, yeah. But we follow.
Sometimes certain sellers will have certain needs, and many of them, for example, have to have cash to get it to distribute to limited partners and such. So.
Yeah, and a lot of them, especially if you're buying out, let's say you're buying out a drilling partnership or something, and they can't keep going back to their limited partners asking for more drilling money. They're kind of peaked out and just kind of living within cash flow. So the only way they can get this liquidity is to get some cash and share. And if the people still believe in the upside of the property, they like getting your equity because then they're still in the game. It's just a way to get the deal closed. From an M&A standpoint, is your preference to buy undrilled acreage or developed, that is just prospects for EOR?
Yeah, all else equal, we like undeveloped. That's where we see value creation potential. With the market valuing companies where they are today, it's really mostly on the relatively near-term cash flow.
Mm-hmm.
And so hence, if you can find things without paying too much for the undeveloped, it represents that value creation potential. We don't see a lot of need for buying production just at today's prices and such, unless we just price it at a really steep discount. Effectively embed an implied return into the price we pay up front. But it offers less ability for us to do something with it.
Right. Yeah. When I was at Hess, we did a lot of business development stuff. And, if we could buy companies for 4, 5, 6 times cash flow, but they had a lot of development drilling locations or a lot of acreage came with the deal, we just acted like we were getting that for free. If we could, get the deal to pay out on existing known proved reserves, then we felt like that was just free leasehold. And especially if it was held by production. So how do the political policies and rhetoric from the current administration in DC against fossil fuels affect your company and industry?
Yeah, on the company front, we're fortunate that we operate in Texas,
right,
on private land, so we don't have any of that federal BLM type that has the extra hoops of regulatory permits and such. That's all fortunate. We've got what we need to operate, and we don't have restrictions like that. We've got a friendly state and so forth. And we've also got takeaway capacity and so forth, so we're not waiting on, say, the Keystone Mountain Pipeline or Mountain Valley and such.
Yeah.
More broadly, just kind of abstract, the rhetoric isn't constructive, I'd say. Some of the doublespeak of going to other countries like the Saudis and asking them to increase production, or even later then asking U.S. companies to increase production, but then a few sentences later saying, well, I hope to get rid of you in a few more years with totally clean energy. I just really wish we had a constructive dialogue that recognized the benefit of all energy sources, that what the primary energy source is now, that's not only energy, but it's also, like we say, oil and gas provides feedstocks for how you make ammonia, which is fertilizer and feeds the world, or plastic and so forth. It'd be helpful and be nice to have a constructive kind of holistic dialogue.
Yeah. And, some of the larger companies that I talk to, they're saying because of this rhetoric that the bad mouthing of the fossil fuels industry, they're having trouble attracting people. There aren't many kids going into petroleum engineering or petroleum landman or even want to go into the industry because they're afraid it's going to be gone in 5 years. And I did campus recruiting for Hess for like 5 years. And, even then it was kind of hard to talk kids into going to the industry, some of the better, students. So I think that's an issue. And, we're going to need oil and gas for a long time, people. And, we got to get past this stuff. And I'm telling you, pay attention to what's happening in Europe, folks, because this is going to change a lot of minds. They're in big trouble. They're in big trouble because they went whole hog, into wind and solar when they weren't ready to do it. What do you expect the CO2 production profile to be without prior water flood versus wells which had water flood first?
To clarify there, we do not have any wells that were water flooded historically.
Okay.
All of ours were drilled just in the last few years. That was horizontal modern day completions. That's the page I went through. One could look at it on the internet or website, page 6. These two neighboring fields have the old vertical wells with the old water flood, and that's how that was produced. Ours have been newer wells. So our average well is 4 years old. Our oldest well is 7 years old.
Yeah.
In general, what I'd say, and that's that page 9 is, what you're trying to do is reduce the production decline, right? You're trying to flatten it. So shale has a really steep decline. Our wells on the primary production basis have a flatter decline, albeit they do have some material decline there in those first few years. And then what an EOR water flood or CO2 flood has the effect of flattening it even further to where you just have this very gradual decline.
Right. And I think people need to understand, maybe the question is, you do inject the CO2 with water. It's not a pure CO2 injection. The CO2 goes into the water, correct?
That's right. It's called a WAG, water alternating gas.
Right. Yeah. When I was at Hess, I think we would do, 2 times as much water and then a slug of CO2. And basically, I was told the CO2 is kind of acts like a detergent, and it strips more oil off the rock. And
it makes it miscible. That's
right.
It
makes it more miscible and moves it. And that's what really pays off. And our zone was the San Andreas, so it was the same zone you guys are doing it on. So that's why I'm high on this project. And I think the fact that it has not been water flooded before gives you even a lot more upside. So
yeah, we're right next door to that.
Yeah, because what happens is, let's say this was a water flooded for a long time, usually when you do the CO2, you're going to double the recoverable reserves. But if it hasn't been water flooded already, you're going to get 2 times that, because you'd probably get the results just from plain water flooding if you wanted to. But with the CO2 it's going to be like a supercharged water flood with the CO2 going with it. Anyway, I'm very bullish on the project, guys. I think you got a lot of upside with that. So I think there's some confusion here, maybe on the hedging. The next question says, over half hedged at 95 and 100. Did I hear that correctly?
No, that's incorrect.
That's incorrect.
Page 15 of our presentation shows the percentages and the prices. This goes back to my comment that we entered the year with legacy hedges from mostly 2020. So about 50% at a weighted average of $57 kind of ceiling price there for this quarter. Next quarter, call it 47% roughly. That's a little lower, 53 or so. Even that 57 probably looks a little high. I know there's some collars in there that'll expire worthless, so that's probably closer to a $53 number. It's this low kind of mid 50s that are there. We haven't attempted to raise the weighted average price because you've still had some backwardation. What the green portion of those bars represents the market, right? So, call it first quarter 2023. You got about 70% at market. So call it what it is, 90, 80, 100, we'll see. That represents your difference there. And then I just put all of those in context of our operating costs, again, are probably in the high teens, call it $20. So, and then break even, call it for a 10% return on a new well, you're probably in the $20 to $30 range too. So we could choose to put on some lower price, some collars with a a wider collar, maybe a floor and maybe $60 level, and you're doing just fine there, and that gives you some kind of upside participation given some of the volatility.
Yeah, yeah.
Hope that clarifies.
Yeah, and Clifford, who posted that, if you'll just send me an email, I'll send you my model shows how their current hedges impact the next quarter. So I've got it if WTI averages $90 net of their cash settlements on their hedges, they should get 73.50 per barrel, around that range.
Yeah, and I'll say one more thing. I'd encourage you to go look at our transcript from 2 to 3 weeks ago. From our earnings call, and I give a little example in there of a bridge, and I say, listen, guys, because of the way the hedges are rolling off this quarter, you only have to have WTI average $85 for the quarter, even though it's much lower. During the second quarter, we had some of that super high spike, $120, right?
Yeah, yeah.
We only have to have it average about 85, 86, and we get the same revenue net of hedges as we did in the second quarter because of that kind of dynamic, along with a little bit of gas revenue and such. So that's something you could check out. Because and then to roll 3 weeks forward, and a lot of the time we've had price above that, right? I mean, we've been, even though it's down today, we're at 89.
Maybe I think. I think it's because you got more for your fiscal fourth quarter. The quarter we're in right now, I've got more gas production going to like 10,200 MCF per day. And as a result, you'll have more unhedged volumes. And I'm assuming for the quarter that Henry Hub averages $8. I'm getting you net of your gathering and transportation expense going from $1.29 per MCF to $3.24. So you should see a pretty high, big lift in your gas price in this quarter, I think, and your realized gas price because of that, as you had more. Yeah, I think it looks great. So anyway, I think that's about it. So I just remind everybody, if you're a non-EPG member, you want to find out more what we do, just send an email to energyprospectus@gmail.com, and we'll go from there. And I think you guys are coming to Houston one of these days, aren't you, for a luncheon? Yeah.
Yes, I believe.
Oh yeah, the 15th. Yeah, in a couple weeks. Okay,
Yeah.
So good. We'll have them here in Houston. So if you're a Houston member, attend that luncheon on the 15th. Get to meet these guys. And, we could chat about all the upside here, but I think it's got a ton. I look at the net asset value. If their year-end reserve report, their audited, Netherlands Sewell year-end report matches what they said for 630. This thing's trading at a nice discount to the proven reserve. So anyway, Philip, Kevin, thank you for doing this. It's great. And I look forward to seeing you guys in a couple weeks.
Thank you.
Really appreciate you hosting, and then all the effort of the investors here, their participation and time today.
Okay. And I'm telling you guys, we're getting a lot more interest in this sector. And the reason we are, I think what's going on in Europe is turning a lot of heads. I think they're seeing this Green New Deal, Paris Climate Accord stuff is not going to work. And we're going to have more oil and gas. And we're probably stuck in a global energy crisis for several years. There's no quick fix to this. By the way, I just saw a report yesterday. Saudi Arabia did not produce up to their quota in July. So old Joe going over there to beg for more production, I don't think they've got it. And I think they're peaked out. And the cartel has not met their quotas for over 8 months. I thought it was just 8 months, and I think it's more like 10 or 12 months. So pretty interesting situation now. Anyway, thanks again, and we'll go ahead and end it there. We'll send you the link to the replay, and you can use it and send it to anybody you wish at that point. Okay, thanks a lot.